Hello, hope you're doing well. I wanted to jump into coverage of just this Excel file so I could walk you through it. Similar stuff that I talk about in the video that kind of covers the idea of modeling out an intrinsic value model. I use snippets of Excel in that video, and I thought it just might be valuable to actually just get right into Excel. So if you're one of my students, you should have access to this template. And I just want to kind of cover what's here and then offer some comments on how and why you would adjust it when you're doing this for your own company. This is a fictitious company. I've tried to make things as real as possible, but it has to be adapted still in many ways. So it's a template. It should be dynamic. The formulas and all are in here, but it will still need adaptation to whatever company you're looking at. So first thing, I'd recommend that you just have a good understanding of, well, here on the far left-hand side, all the items that you'll likely see on the income statement. I created this to be, so we don't have to do the adjustments to adjustments, all of the busy work that unfortunately accompanies valuation, not because that's wrong, but because it's just very time consuming and not really changing anything. So this is set up to actually use the information that's already presented on the income statement for us. Does that mean it's exact? No. I have like two revenue streams here, cost of sales. I've calculated gross margin. I've calculated total revenue, et cetera. So operating expense 1 and 2. The reality, as I want to get into here, is that you could have more revenue streams, just add in a row. You could certainly have more operating expenses. Again, just add in a row. Your company calls it cost of revenue or cost of goods sold. I would just, to match, I would update it and just put in their labels that the company's using. The subtotals, I probably wouldn't recommend changing. No matter what, you should be able to calculate total revenue, something like gross margin, et cetera. So I have calculations in here. I'm not in any way saying that income from operations or operating income, those are calculations. But take your company's data, look at the accounts on the income statement, and try to match them up here with the same organization we see on an income statement, but likely with some adaptation, meaning you might be calling operating expense 1, sales and marketing, operating expense 2, research and development, right? It's going to change based on the company, but hopefully this works. So let me jump over here. These are the assumptions, and these you really definitely want to change because your whole point is that you're trying to think about what are your assumptions. Some of the things here you don't want to change, like the calculations, as I was saying before. And you do want to, I would say, I do recommend thinking about like my discussion or description of what is the driver of the forecast. Like, revenues are commonly calculated as growth rates. I would recommend doing that. Is it, absolutely 100%? No, but I would probably recommend doing that. Expenses, well, operating expenses are a percent of total revenue. So I would recommend using that. Now, why did I use 14%? I just made it up. Why did I use 70% for cost of sales? I just made it up. What about 10% and 5% for my revenue growth? The specific numbers here do not use. These are made up. These don't apply to your company. Don't do valuation if you're just going to copy my numbers here. But it is reasonable to copy the format, the specific driver. All right. Now we jump down here a little bit just so we're clear on some of these. So like interest expense, as I have here, it's cost of debt on financial liabilities. I'm going to actually mention this one because what we have here is this is likely going to be, and again, don't take my rates here. These don't mean anything, but this is going to be one where you want to link it to the balance sheet as I'll show with the forecast. So it's likely not a percent of revenue. It would almost surely be, like in this case, like 5% of my average debt balance outstanding. Rate of return on financial assets. Again, I'm not debating my numbers, but I am talking about the process here. This would likely be, hey, look at my financial assets. Like, does my company have marketable securities or something like that? And the answer is no, that's fine. But, if it has it, you're going to tie this to the asset balance. Other income gains, losses, and expenses, I actually left that in there because when you're filling out your historical data, now's a good time to me to kind of jump over here. So this is not a real company, but this historical data is not a part of your forecasting. These are all just inputted directly from wherever you got your information. I strongly recommend going to the SEC, grabbing that Excel file. Again, you're going to have to make some changes because they're probably not calling them operating expense 1 and 2. I'm certain they're not. But, just try to look at the general format of a US GAAP income statement that I'm offering here and follow this and grab the company's actual numbers. So in this case, I have 1, 2, and 3. That'd be like number 3 is like the most recent year. Number 2 is the 1 year before that. 1 is 2 years before that, et cetera. So these are where you're going to input your historical financial information. This is not a forecast. This is not, modeling. This is just data entry at this point. I would get them all in there and then just make sure they tie out to the net income that you see in the company's financial filings. Before I jump over to my forecast, I just want to go down here a little bit. I have a discount rate in there. Again, that's just there so I can link my cells to it. I'm not at all debating what that discount rate should be here. And then I actually put in, I'm actually going to expand this here. I do a little bit of grouping here. That's just my series of sales growth, gross profit margin. There's a series of ratios and metrics. And in no way should we assume that this is our forecast, but it's a great way to check what we did. So if your business-based story for valuation was talking about a certain amount of revenue growth, was talking about a certain amount of operating margin improvement or gross margin improvement or the other drivers of value, the point of calculating these ratios is just to confirm if that was the case. So if you were saying, look, here's my thesis for expanding margins as they shift their product mix or something like that, well, you better see expanding margins as they shift their product mix. So this is just making sure that like the ratios align with our overall story. So I put them in there. And if you move around rows or something like that, you're going to have to update these. If you do exactly my rows, they're all linked, but you might need to change things. Just as an example, you might need to add in extra items on your income statement. Just check again to make sure these are all correctly updated. In many ways, that's not redoing the formula, but you likely want to just jump in to the formula in Excel and just, make sure that it's linked to the right cells. And if not, just move it. I would say don't delete these, but you're still using the same basic idea. You're just making sure it's linked to the right thing. As I go down here, what we have here is the equity valuation. I think someone once said like, hey, this is not the way, people report equity valuation. Yeah, I know. The main point of this is to just express in an educational setting, which is what we're doing here, exactly what we have. So I'm just listing out the basic steps that we all use when we do free cash flow to equity valuation. So, and I'm this is kind of an obsession. Like I just like to be direct and explicit about things. So I don't like to bury things, especially if this is your first time working on a valuation model, the first time you're building an intrinsic valuation model. I'd rather just list these out. And then this is what you're going to fill in with your forecasted years as we have these, but I won't cover them yet. But I'm just basically going through this again. And then I list out arguably more steps than you would probably ever see. So I am not in any way saying that the way I've listed this is great for presentation purposes, but it's useful for, hey, I have to calculate this. So there's definitely erring on the side of how do I walk somebody through the process step by step instead of, ooh, that's the prettiest way to show a DCF. I don't think anyone would agree with that, but it is, we make so many mistakes when we're doing DCFs. So, especially when we do the weird adjustment to adjustment approaches, that my hope here is just like being explicit and direct. Let's just work step by step and reduce mistakes, like mechanical mistakes. So that's why I kind of have that there, just to work that out. I also, in this model, I'm tying it out to residual income model. It's a far less common compared to like traditional DCFs or free cash flow to equity model, as I have up top. But if you want, check it out. The beautiful thing about these is if you do them right, they tie out. It just is a good reminder that the values are going to be the same, that, the value is not related to the model we choose at all. And if it is, it just means we made mistakes with our models. We could have made 1 million mistakes or 2, whatever else, but there's nothing, we should never be saying that the value is contingent on the model that I chose. That itself is a fallacy. It just means we either made a mistake or we aren't understanding valuation of the model that we chose. So they should exactly tie out. Actually, you can do the same thing with a dividend discount model. I just don't have it here for just to show too. All right. And then I have my balance sheet. Again, the same thing as I talked about in the income statement. I try to model this after actual companies' balance sheets in terms of organization, but not literally. Nobody lists current asset 1. I'm just giving you a filler with this template to fill it in, current liability. But one slight difference here, though, is that I've organized it with like really actually related to the impact on cash flows. So I put the balance sheet items that are associated with net working capital together, assets and liabilities, and then the balance sheet items that are related to capital expenditures or financial liabilities, I put down here. So I did reclassify the balance sheet a little bit, slightly different from a traditional US GAAP balance sheet and more consistent with the way that we look at valuation. So all the pieces are here. My balance sheet, as I have down at the bottom, will still meet all the requirements where like assets equal liabilities, and it will all balance out as it does. But it's just a slight reorganization, and not just in general, but actually because a valuation model with cash flows requires that we reorganize some aspects of the balance sheet. So I did that here. I'm not changing. I'm not removing. I am slightly changing the organization, but everything is there and everything's accounted for. My balance sheet still balances. I also, like I did with the income statement, I leave a bunch of ratios in here just so I can check. These are already pre-populated. So if you don't change the cells, these should work. But if you change the cells, which is perfectly fine because your company might not be the same, just jump back in and check out to make sure that the cell references are accurate for your situation. Then I threw down here at the bottom like a simplified statement of cash flows. The reason for this is, just to be clear, you don't actually need to do anything with the statement of cash flows when it comes to valuation. Given that company value is driven by revenues and expenses and a little bit of how do you use your assets, that really is the entirety of it. And cash flows are just how we count value. They're not related to the driving of value or the way the business is conducted. We naturally, by doing the valuation model, we're doing the translations to cash flows within our model. So we don't actually need a statement of cash flows. I still include it anyway for completeness. You might have kind of picked up on that. My goal is to be thorough and complete and not to skip steps. If your goal is to do valuation and take as many shortcuts as possible, just know that that's in contrast to the tenets of finance, except if you're saying that, well, my shortcut with valuation is to do an index fund or an ETF. So I get an exposure to a diversified portfolio of securities without having to value any of them individually. So that's a brilliant shortcut for individuals who are not interested or don't have jobs related to valuation. If your job or you're personally interested in doing valuation and building intrinsic value models, I would not recommend taking shortcuts. That kind of contradicts the whole idea. So I have a simplified statement of cash flows. It's just kind of organized by general category. I have the complete one. And by that, the step-by-step statement of cash flows, I probably could have labeled that as just like a usual GAAP statement of cash flows where you see all the traditional stuff. This one actually is still kind of designed to tie to the balance sheet. So not really much there. I'm just doing it for completeness, or really just to show you, hey, if you do this right, your statement of cash flows is going to be like your cash check is going to tie to zero, because the financial statements all work together. All right, I just kind of walked through this so far. I've actually not got into forecasting or valuation at all yet, except the setup of the model. So I want to do that at this moment. I'm going to right now just hide my historical financials so I have a little bit more room to see here, just so you know that. Let's assume I've already put them in, and I've already thought about this. So where am I spending my time on valuation, just to be clear? I'm spending my time on coming up with my assumptions, and specifically on coming up with my assumptions about revenue growth and margins. At the end of the day, the primary thing that's going to drive your cash flows, the primary thing that's going to say the company's over undervalued, is expectations about revenues and margins, and then also risk or discount rate. So that matters too. But in this case, I'm going to try to spend my time thinking about revenues and expenses. So I'm just giving you them here. Please don't use these, as I said, but then they drive my forecast. So let me just kind of go through that here. I'll cover a couple of these. And I have these 3 periods here: initial, forecasted year, secondary, and terminal. You always need at least a terminal period, and the terminal period has 2 columns. And then you can actually choose if you want initial, secondary, etc. In my other templates, V2, V3, that's not clear where that is. Let me go to the top here. I'm sorry. I actually doing something different where I'm still using the same idea of initial and secondary, but I'm changing the amount of years in each one, except the terminal period. The terminal period is always 2 years, the way we use a perpetuity. That's not unique to my model at all. It's just that's the math of a perpetuity. But the initial forecasted are 4, the secondary are 3. In V3,
The initial are, I don't remember this off the top of my head, that's why I'm looking. 5 years. The secondary is also 5 years. So I'm not in any way saying one is right or wrong. But one thing you do want to note here is that actually changing the horizon over which you make your forecast will change your will change your value. And generally speaking, like the longer you give a company to grow or to improve its margins, and specifically to grow, the bigger impact that's going to have on overall company value. So let's just work with my valuation model one template, just because, I mean, I hate to say it, it's just because it's the shortest. So it's easiest to see in Excel for this video. And all of the ideas follow through the others, but don't in any way assume that this is the best or the one that you should use. You really want to think about what are the periods that you're forecasting? What is the horizon of which you have information? So let me just give you kind of a quick comment here on this one. If I just have initial forecast years of four, like the next two, four being upcoming, because 1, 2, and 3 are my historical, and then secondary of 1, and then terminal years, I'm arguing in this case, my company is pretty close to its steady state. Not literally in its steady state where I would use a perpetuity, that's the terminal years, but we're pretty close to it. So this is not, like if this was a real company, I couldn't be pitching some innovative hyper growth story. If you want to pitch that, you can't say that, it's this innovative, disruptive company that's going to change everything, usher in hyper growth, and it'll be in its steady state in 4 years. That's not going to happen. So you could argue this is more of a near state, very, stable like company that I have here. And actually I would say valuation 3, if you're using that could be more of your innovative, disruptive, in some ways like higher risk, but maybe more interesting set of forecasted financials. So what are we doing here? I'm using my formulas. And again, I've set all these up to relate to basically that's just saying that the growth rate of the historical financials, maybe I could have left my last year in here. Let me escape out of there. Unhide those. I'm just going to hide my last two, those two, because I don't really need those. I think I'll be fine at that. Whoop. Sorry. I'll leave my last year there because it might make this a little easier. So I'm basically saying, if I click in that formula box, my growth rate assumption is 10%, and don't copy that. That's just to get this thing started. And therefore, my revenue in the historical period is going to grow in the initial period at 10%. So I'm just mathematically putting that in. I'm doing the same assumption for the second year, which is year 5. But then in the secondary period, I naturally change my formula to match my secondary period assumptions. So all of those in the secondary period are linked to these. All of the initial are linked to this initial. You could actually do this year by year. You don't need to do initial, secondary, terminal. You could actually do an individual forecast for every year. It might take some time. It's not necessarily better or worse, but that could be done. And then my terminal years naturally are going to be linked to my terminal period assumptions. So let's go through just one of these here. What do I have there? Nice simple one. Well, if I'm saying that operating expense 1 is 14% of revenue, well, then after I forecast my total revenue, I just mathematically make that 14%. If you're using the same lines, you don't change anything, these formulas should update, but check. I really want to encourage you to check to make sure that's the case. Again, check by just clicking inside the Excel formula box and then saying, is that total revenue? Yes. Is that initial period expense as a percent of revenue for this item? Yes, it is. We're good to go. All right. And then naturally, if I was doing the terminal period, I'm still making it as a percent of total revenue, but I'm linking it to the terminal period forecast, as you can see there. All right. I mentioned these up front. I want to actually jump to this one. Interest expense. I just want to note that, I've determined my cost of debt capital being a 5%. I'm not debating whether that's the best one to use, but as I have there in the formula box, that is set to be the average of I-88 and J-88. Well, that's actually my total interest-bearing debt. So I'm not linking that to revenue. That wouldn't make sense. I'm linking it to my balance sheet. I know we can't see our balance sheet now, but that's the integration. So another important thing is you want to make sure that your forecasts are integrated across your balance sheet and your income statement, and actually then will tie out to the statement of cash flow. So it's not all percent of revenue. You definitely want to make sure that the formula is tied in a logical way. So whatever line you're using, whatever the company has, try to make sure that you have your thought and your plan in mind of like, wait, what would drive that expense? Okay, so that's the general idea. I'm forecasting everything out. I'm going to jump down to the balance sheet before I go to my valuation, because I'm actually going to end with my valuation. I'm doing basically a similar thing with my balance sheet. My forecast, I have my terminal period, and a lot of these are naturally linked to revenue. So, I mean, it makes sense. I'm going to have items on the balance sheet. Inventory is a good example, right? I'm going to link this to revenue. Now, how did I do this forecast? I can mathematically just create an equation so that my formula is basically using inventory days outstanding, using cost of sales as I have here. So you can check out these formulas inside Excel, but the general idea here is what's the primary driver of that item? Well, it might be easier to think about inventory as a turnover or accounts receivable as a turnover. So I've done that across these, and I'm doing the same thing as I did in the income statement. My initial are linked to my initial, my secondary linked to my secondary, my terminal linked to my terminal. Importantly, it's probably worth noting here, the terminal one. On the balance sheet in your terminal period, you should have no creativity, no change. And I covered this in the other video. The general idea there is that in the terminal period, you're really saying everything is constant. And I want to be clear, this is not at all specific to this model or modeling free cash flows to equity or anything like that. The point I'm making is entirely what you need to do if you're ever using a perpetuity in valuation. In that you need to make sure that the steady state assumptions hold, and they're covered in the earlier slide deck, but I will cover them again. The nice thing about the steady state assumptions, it actually means your balance sheet forecasting is super easy. Everything grows with the steady state revenue growth rate. Everything on the balance sheet, everything on the income statement, everything. It's boring. That's the whole point. Steady state means when the company is no longer engaging in meaningful change. It doesn't mean they could never change, but you're arguing any change at that point is just noise, so it would naturally net out. You're not trying to argue whether it's 3.001 one year and then 2.99, not whatever, in the next year. It's like, well, the answer is like it's going to net to 3%. So that's actually why I've eliminated all of those assumptions there, because everything is just growing with revenue. It makes it simpler. That's the case in the terminal period. Why? Because I have my steady state assumptions. One single constant revenue growth rate, all margins grow, all margins stay constant, which is the same as saying expenses grow at the same amount. My asset or asset efficiency or my turnovers all stay constant. My capital structure stays constant. So I can change my mix of debt and equity in the initial period, the secondary period, if I wanted to, if I had a reason to do that. But in the terminal period, to use a perpetuity in the steady and to say that the steady state applies, I have to assume at that point I have constant capital structure. And then finally, constant risk. I can't have like an expectation of fluctuation of risk in my terminal period. I mean, I can do all those things, but then I just can't use a perpetuity. So the simplification of making this just a mathematical, the value and the terminal period being just using the math of perpetuity requires that I'm assuming at that point the company kind of hits its steady state, and everything gets pretty simple there. All right, so that's my general idea here. I use different answers. I'm not saying these are the only things you could see. Some grow with total revenue. Some are kind of turnovers, turnover with property, plant, and equipment. Others just grow with total revenue, et cetera. And so you can check mine out, but it doesn't, feel free to kind of alter and update these as you want to make sure they work with your own thing, your own company. One thing I would say, though, is I wouldn't get too crazy. And, if you have some expectation of improvements of efficiencies, put them in. But, make sure they're reasonable, because there's natural limits to everything. So really, if I was going to spend my time, I would be making sure my balance sheet is reasonable, but it's not going to fundamentally change or drive value. So I would still spend much more of my time on my income statement, specifically my revenue, my operating expenses, and then I'm just making sure everything else ties out. Importantly, you are going to have to use a plug, a check cell or a plug. And in this case, I use like total financing assets my first 2 years. I'm not saying that's best, but it's reasonable. I am saying that, which is that in my initial years, I might be saying that, well, I don't want to distribute my money back to my shareholders via repurchases or dividends yet, because I just want some flexibility in case I need it more cash to grow or to expand or to buy things. And so the plug is it's basically saying, what would have I need to do to achieve a certain level of performance in the year? So this is not like a double entry accounting thing, but we are saying that if I were to achieve a certain amount of revenue and assets and everything else, like what would be like the last piece to make that work? And so in some ways, and I don't have it here, but like if your plug could have been debt, right? Like, well, if I needed to buy more assets than I currently had, one thing I could do is I could plug debt, assuming I had like a company that could issue debt. And that the answer there would be like, well, if I wanted $100 of assets, but I only had $80 of expenses, if I forecasted $100 of assets, it's not that I have it yet. Like, what would I do to make up the difference of $20? Well, I would borrow $20 of debt, and that doesn't change my cash account, right? I would be like, increasing my debt account, increasing my cash account, but not really increasing my cash account. I'd really be saying that I would have deployed that $20 not into cash, but into other assets. So if I wanted $100 of assets and I only had an expectation of $80 of liabilities, I would naturally take on an additional $20 of debt to get there. So that's like the idea of the plug. However, in the long run, and I want to be clear, because I'm forecasting, I just created this company to be like a successful company with, positive and growing margins, growing revenue, stuff like that. If you're modeling that, a successful company that performs well with real profitability and real cash flows over time, and maybe you don't think that's the case for your company, that's fine. But if you are modeling that, at some point, you're going to have to switch your plug to be equity. And basically, it just means that once a company is doing well over time and generating significant amount of profits that translate to cash flows and more than it needs to redeploy in its business, naturally, that actually means that they would be able to return that capital to providers of shareholders in this case. So, and this matters here. Even if the company's never paid a dividend, if you forecast them to have consistent profitability, consistent growth, consistent cash flows, you would either be stockpiling cash to an absurd degree or you would be. So it doesn't matter whether or not they've paid dividends. If your forecast says consistent revenue growth, consistent profitability, you're either saying the company is run by complete idiots, but then why would you sort of be, saying it's worth investing in? Or naturally what they would do is they would switch at that point. Like once they've achieved all their goals and they would begin to do repurchases or dividends. The nice thing about the equity plug is we're not making any comment about repurchases or dividends. It's just could be interchangeable between the two. And basically that as we have excess cash that we don't need to redeploy into our business, this negative number, it actually means that we're going to pay that out as dividends or repurchases to our shareholders. What enables us to do that, even though we haven't done that before? Well, I'm forecasting expected sustained profitability and expected sustained revenue growth, which would naturally give me, excess cash over and above what I need. So this is really just, hey, given my revenue and margin forecast, this is just a natural or logical result of it. So the plug really follows from that. Now, what if I was expecting the company not to have profitability, not to have revenue growth? Well, I might have a plug that's making up the shortfall, but I wouldn't have a plug of equity here because they wouldn't be able to pay it out. But that's just not what I modeled in this particular case. All right. So the way to do the plug, though, is you want this balance sheet cell check to work. Actually, let me just do one of these. I'm going to delete this. So basically, I'm going to delete this to show this. Like that's the way I would work it out. I know you can see the answer because it's the terminal period, so it's kind of boring anyway. But how would I do that? Let me do this, actually. I think I can do this here. Yeah. Let me just delete this, pretend it's not there. So if I delete that, it's actually going to screw everything else up, but that's not a big problem. So like, here's how I would work out my, I know I've already solved this, but say you're doing this for the first time. I want to click on my balance sheet check cell, which I just did. And then I'm going to go to data, what if analysis, goal seek. And then I want to change my balance sheet check cell to 0 by changing, and this, you're not necessarily choosing this exact cell K83, but you're choosing by changing the expected plug in that particular situation. And then if you click A on that, you'll click OK. I'm sorry, I don't know why I said A. It will actually iterate through and Excel will solve it for us. And the beauty of that is it's basically saying, what would the incremental amount of total additional investments like financial assets, marketable securities be in order to get this to balance? And Excel, as you saw, does that pretty quickly. You could solve this by hand if you wanted to and just iterate through your model, but I don't recommend it. I don't know. That would take quite a bit of time. This is not advanced use of Excel, but I think, basic use of Excel is certainly the case. You really wouldn't benefit from doing any of this by hand or trying to add all these up on your own. All right, so that's my balance sheet. When I'm done my balance sheet and my income statement forecast, that's actually when I want to jump into my valuation. Now, to be clear, I've already populated all the valuation stuff, so you don't really need to do anything, except as if you change columns and rows, you do want to make sure these are correct. So what are you doing here? Back to what I mentioned. You're just making sure that like you have in that data, whatever I say that is. So that's net income. It just means equal net income cell. Second one, let me go to the middle one. So say I'm doing year 5 here. The first cell is K31. It has to be equal to my net income. So if your net income is K20, you're done. If your net income is K21, because it could be, right? Like that's not crazy that you'd have that in one line. Make sure that you're linking that to net income. And then what? That's my change in working capital. When I do my balance sheet, I already set it up so that it's calculating my change in working capital. Now, to be clear, the change is the next line. I calculate my working capital based on my assets and liabilities, and then I calculate the year-over-year change to get my net working capital with the change there. So play around with my formulas until you get familiar with it. That's why I really wanted to give all the formulas here. Look at what I'm doing. Make sure you understand the process. I'm clearly not, I don't want to just give you the numbers here. I want you to poke around in these cells and have a good understanding of what that is. But at this point, though, because I've already built up my financial statements, I'm just linking this to the particular cells. So next one, subtract net CapEx. This is basically my growth CapEx for the year. And in my prior videos, I kind of cover why. It's much more simpler and straightforward to use growth CapEx than to use the kind of circular approach of adding back depreciation and then subtracting out total CapEx, which is just growth CapEx plus depreciation anyway. And then I adjust for my net financial liabilities because this is free cash flow to equity. That would be a different step, actually, if I was just doing free cash flows to the firm. And then I'm just adding them up. All right. So that's just me adding up those 4 columns. Why did I write these all out? Why did I just add them all up at once? Well, just so I don't make mistakes. Do you literally do most people doing valuation write out all of those steps? Maybe not. That's fine. And then I do the present value. I also like to separate that out just so I have my dollar amount so I can see it and then my present value. And for me, it's just nice to eyeball. I know what, if I'm at 618, I know that my present value has to be less than that, so if it was like 618 there and that was 629, I have a problem, right? So I like to have everything step by step so that it's a little easier to catch mistakes. But this row here is just this row here is just the present value of the prior row. And then what do I have here? In my terminal period, I'm actually doing the same calculation, except it's different with respect to that last terminal year. The first terminal year is basically when I go into the terminal period. So I'm technically not yet in a steady state. The reason I have all models should have 2 periods, 2 years in the terminal period, is that you need to do 2 things to achieve the steady state. You need to go into it. That's terminal year 1, in this case, year 7. And then you need to be in it when you're actually in the steady state. So when you're going into it, you're changing into the steady state. But when you're going in the steady state itself, which is actually year 8 here, the second terminal year, and actually all terminal years thereafter, 8, 9, 10, 11, whatever it is, that's actually when I'm in the steady state. So I didn't just go into the terminal period, I went into the steady state. So in that case, I'm actually saying that's the big number I really want to mention here. It's unfortunately, the way math works, that's the primary driver of valuation. So that number there is the terminal value itself. So what's the total value of the company in that terminal year if it were to continue indefinitely? But I'm still not done because I need to discount that back to today, which I did on the next line. Many people will combine these 2. That's fine. I don't. And then what? I add up my pieces. Check that out. I get my shares outstanding, which I've just, I'm not forecasting. I'm looking that up, and I'm getting that to get my estimated market cap, in this case, price per share. So I said that wrong. That's actually like my estimated market cap. And then given the shares outstanding, that's my price per share. In this case, I'm hypothetically saying if my stock was valued at $14 a share, I'd be expecting a 28% upside based on my revenue and margin projections, and I'm recommending a long for that reason. All right, I'm going to jump down to the residual income model here just to kind of show you it. It's similar. It's actually somewhat easier. Just there's a slightly fewer steps, but not really that big of a difference. So I don't want to make a big stink about it. And it's not identical. The steps and the organization is different. But it's actually still the same process. I have to put together my 4 pieces. That gives me, in this case, the residual income, which is net income minus required income. And then I need to figure out the present value of that, the present value of the perpetuity value, the present value of the perpetuity, and add them up. So this guts of it all will always be different. But if you do them correctly, your residual income model should be exactly the same for the total market cap of the company. My shares are the same. My price per share are the same. Of course, my stock price is the same. And so I get the same investment thesis recommendation. Just to repeat this one more time. And then I have a check there just to tell me if they're not the same, just so I know I have a mistake. But I want to emphasize this because it's really important. There's no reason that your model, I did this kind of DCF, I did this kind of approach, I did whatever. If your models are giving you different answers, that just means there's a fundamental misunderstanding of valuation. There's a fundamental misunderstanding of models. There's an error in the model or something else, right? Lots of things, but the model should give you, if you're truly basing it on the same assumptions. Now, if you're basing it on different assumptions, that's fine, but then naturally, mathematically, they would give you different answers. If you're truly basing on the same assumptions, your model should give you the exact same result. The value of the company is based on your assumptions about revenues and margins and risk. It's not related to which model you choose, which adjustments you make, or how complex and inaccessible you can try to make this. So hopefully this helps in just walking through what's here. Big thing is you got to adapt it when you're doing your own. You will certainly not literally have these exact lines, but hopefully it's a good template that lets you adapt it. As you adapt it, make sure that you can track the formulas. Don't assume that just because I have a formula, everything I have is a formula, and they're linked and they're cell references. So they really should update. But don't assume that just because there is a formula, it always perfectly updates. Just go in and check and make sure that's the case. And then think about which model do you want to use, like what's your horizon in different ways. Consider that. And I guess have fun. Last thing, just a piece of practical advice is, always keep the template handy. So as you're working on it, I would just save an extra tab of the template in case you make a mistake. You can always kind of remind yourself what you should have done or go back to it. I've definitely made mistakes and eventually fix them all, but usually don't get it right the first time. There's some cell reference or some other error that I have in there. All right, well, hopefully this is useful. Enjoy, have fun modeling, working on this. And if my last comment here is spend your time thinking about what drives value. It's company valuation, DCFs, relative valuation. No matter what you're doing, no matter what your role is, it still is always a conversation on revenues and expenses. And if you can spend your time anywhere, spend it there. Of course, mathematically get the valuation model to match. But your story is about revenues and expenses. All right, take care.